Welcome, my name is Peter and today we are going to be doing a Buffett style value analysis of a company in Poland, TXT. This company has great margins and currently is after a significant price drop that is not correlated to the drop of earnings or the drop of revenues. So it's a great company that can be bought at a cheap price. Let me check if the recording is going on. Yep. All right, so this is the summary. We are going to be looking at the most fundamental, the most important things that Buffett himself and the rest of the value investment community looks like. So first it will be the circle of competence. So we'll talk about what this company does. Then we'll look at the earnings, the revenues and profits. Also later at the margins, so what is the profitability of this company and how is that changing throughout history? Are the margins getting better or worse? Then we'll look at debt levels to see if this company is a safe investment. After that, we'll be looking at durable competitive advantages. So something that distinguishes this company from its competitors and will let it prosper in the future. The sixth point will be retained earnings. So we'll see how much of the money that this company is generating is going back into the business to help the growth, etc. After that, we'll look at the current valuations. So as I already told you, the valuations are low. This company is currently cheap compared to valuation ratios in the past. Then we'll look at cash flows to see what are the real earnings of the company. After that, we'll look at the growth. Warren Buffett wants to buy and hold. So we want to see a company that can compound over a long period of time. And lastly, we'll look at the management. Is the management fair? Are they good for the shareholders? So let's start with a circle of competence and we'll answer the question, what does TXT do? They have live chat. It's a live messaging tool that allows businesses to talk directly with website visitors in real time. They also have chatbot. It's a platform that uses AI chatbots. It is easy to use by businesses and it can provide assistance 24/7. It also has a help desk. It's a modern ticketing system designed for managing customer service requests efficiently. And it also has a knowledge base. It is a tool that allows companies to build self-service help centers and FAQ sections. TXT also works with AI, and it is a key part of the company's strategy. Their chatbot products, for instance, is the one that is most driven by AI. It uses machine learning and is a little bit like intelligent, we can say. So it can make an automated conversation with a client, answer some questions and help them. And the company is gradually implementing AI across its other products. Now we'll look at consistency of the earnings. So in here we can see a 10-year chart. First we'll start with the revenues, then we'll go to earnings. So we can see that the revenues are very stable over the last 10 years and they are growing at around 25% per year. So this is a huge growth, but sadly it slowly slowed down. If we look at the last 5 years, the growth is at around 20%. So still it's a huge rapid growth. The last 3 years, it slowed down even more. Right now it's around 11-14% of growth per year, so still very solid. But in here, this is a quarterly chart. We can see that it's not as stable in recent years. And now going to earnings. So this is earnings per share here on the chart, and we can see past 10 years the growth was at 15%. So we can see that they can sustain, or at least could sustain, their margins because the revenues and earnings grew at the same rate. On the quarterly chart here, on the 5-year chart, we can see that during one quarter they had some issues and the earnings per share during that quarter dropped to around 0. But other than that, it's a stable level, although in most recent years the earnings hasn't grown much. As we can see here, at the last 3 years the earnings are around 2 to 1.5 per share, and they are not growing rapidly. The trend line for the last 3 years is just a 2% growth in earnings. But of course, later we'll look at cash flows to see what's going on with those earnings, because maybe this company has a lot of investments and they are driving the short-term earnings down, but in the future those investments will produce even more profits for us. So let's answer the question, why did earnings growth slow down in the recent years, in the last 3 years? So tax growth has slowed in recent years for several reasons. Many of its small businesses customers have struggled financially, leading to higher cancellation rates. So they just cannot afford their product. This is not a product that they need, so they can resign from it and still continue their operations. So if the economy is going bad, if there is less money in the system, then this can lead to more and more customers canceling the services. As with any product that isn't like 100% needed to survive. The company also made changes to its onboarding process and pricing. So they created recently some bundles that were difficult to use by the client. So they are moving away from that. And seasonal drops in customer traffic have also reduced demand for its services. In response, TXT has simplified the onboarding experience, updated its pricing strategy, and is now focusing more on selling AI tools and expanding within its existing customer base. The next point is margin. So we will look at the profitability of this company. So those margins are the highest margins I've seen in a very, very long time. So for instance, the gross margin is at 80%, return on equities 123%, return on assets 75%, return on invested capital 110%. So those are huge margins. But as we can see, in the last 2-3 years, the margins dropped, but it is a very small drop. From the level of around 86, it dropped to 82. This is for gross margin. So they were stable since 2015 till 2023. They were stable, but during the last 1 year, 2 years, it dropped, but only a little bit. In terms of percentage, that drop is really not that significant. And when we look at return on assets for the last 10 years, in here we can also see a drop, sadly, from the peak in 2015 at the levels of 110%. Right now, the return on asset is at 80%. So it's a little bit lower than it used to be, but still this number is enormous, much better than majority of the stock market companies around the world. So the margins were great, but let's look at the debt levels to see if this company is safe, because the price is dropping, so there should be some problem with the company. But if we can see here, all of the liquidity ratios, the current ratio is at 1.8, quick ratio also 1.8, and cash ratio is at 1. So there is no problems with liquidity, at least in the short-term period of the next year. But if you look at debt levels, you can see that this company has no debt. It has some liabilities, etc., but no debt. Debt to equity is at 0.01, and cash is 81 times more than debt. So they don't need to loan money, then they don't do it. I don't know personally why. If they have such a big margins, they probably should borrow a lot of money and earn even more. But maybe they are conservative, maybe they like to play it safe, or they might have enough money to do all of the investments that they want from the cash flows that are coming from the company. So maybe they don't need to borrow all this money. However, the current cash per share, I think, is around 3-4. I'm not 100% sure, but we'll look at the cash flows later. Right. Let's talk about durable competitive advantages. So this company has a strong customer base, and right now they are focusing on working with the existing customer base and selling them more and better products. They also have integrated product suite. It works in a way that they have a bundled content, and their clients own different products. So they own live chat, chatbox, help desk, knowledge base, all at the same time. So it can be more difficult for the customers to switch providers. They also focus on creating high quality services and products. They also are doing innovations and are working with AI. So this is one of the things that some people can be scared of, that AI will take profits of text, but if they are using AI themselves, this will probably boost their profits in the future. So AI can be dangerous for a company if this company is not going to use it, but if they are going to use it, then it will probably be a beneficial change. They also have strong financial strength and low debt. So in here, the competitive advantage, what can be seen and is certain is the fact that the margins of this company are huge. And huge margins usually mean that there is some sort of competitive advantage that this company is using. Let's look at the retained earnings. So if the company creates money, earns money, how much of that money is going back into the business? So TXT is a company that pays dividends, and currently after the price drop, the dividend yield is around 10%. So have that in mind, that not all of the money is going back into the business. They are also transferring it to the shareholders, which is nice. I personally don't like dividends because they are double taxed. So the company pays tax on the money it earns, and then it sends it to you as a dividend, and you pay tax on this money again. So not a good thing, in my opinion, to spend all of the money on dividends. But if they generate a lot of profits and maybe they don't have enough in good investment opportunities, then it's better to redistribute this money through dividends or share buybacks. But we'll look at the cash flows later to see how much of that are they doing. But the retained earnings has been going up in 2020. So the last 2-3 years, the retained earnings went down. So this is not quite a good sign, but previously the earnings were growing stably. The trend line is at around 12-13%. So it's very good. And now let's look at the valuation. So we can see a huge miss between the movement of the revenue, the purple line here on the chart, and the movement of price, the blue line. So you can see the revenues are steadily growing while the price is crashing. So the price went down more than 60% while the revenues grew. And this looks similar to the relation of price and earnings, although in here we have a stabilization, maybe a very slow drop in earnings, while the price of the stock crashed. So in here we can see that there is no correlation between the dropping price and stable earnings. Of course, this can be this slowdown of earnings here. It can suggest to some analysts that this company stopped growing and it won't grow in the future. But this is of course a speculation, some sort of a forecast. And if we look at the revenues, etc., you can see that the company is continuing to grow. Maybe it will not grow at such a high rate as previously, but still, because the company's earnings slowed down doesn't mean this is a bad company or whatever. You can see a similar situation here in 2022. The earnings went down, the stock price went down accordingly. So this in here, the market was much more efficient than it is right now. After that, the earnings went up, the price also went up. So it can change. A slowdown in earnings, a drop in earnings in short term doesn't mean that the company is going to be bad in the future. Their earnings growth can come back. And if we look at the basic valuation ratio, so the price to earnings, we can see that the current level is below the previous all-time low. So during 2019, we could buy this company at PE of 10. Right now the PE is 8.5. So it is lower than the previous local low. And I don't have it here, but the price to sales ratio is also very low. Currently it is at 4 and it is below the local low of 2019 that was at a little bit above 5. But all of those numbers are way below median and they are currently at the lowest levels since last 10 years. So it is a great opportunity right now, at least for the valuation ratios. They are very low. This company, look, the PE ratio during the 2021-2023 period was at around 30. Right now it's at 8.5, so more than 60% lower. And next, let's look at cash flows. In here, we have the operating cash flows and investment cash flows. What I like to see is low depreciation amortization, and this is a very low number for TXT. The net income from continuing operations is at 180 million, while the depreciation is at 20 million. So it's a very small part of the overall earnings of this company. And this company can generate a lot of money from its operations. The investing side also looks good. We have, at least since last 2 years, 30 million per year of purchase of plant, property and equipment. So it's always nice to see investments, and remember, those investments further decrease the earnings of the company, while in reality those investments will make even more earnings in the future. So it makes the valuation ratios look a little bit worse in the short term, but it will benefit the company in the long term. So it's very good that we can see at least this 30 million of investing cash flows. And cash flows from financing, sadly, what I can see here is a lot of the money that this company is making is going towards dividends. So if somebody likes dividends, this is a perfect company for them, as it pays a lot of their earnings in dividends. For me personally, I don't like to be double taxed, but what can we do? The cash position is stable. They have a lot of cash compared to its debts. So if they don't have any more investments that they can make, it's perfectly fine to pay out this money as dividend. I would much rather prefer this company to grow even quicker, but I know it can be difficult to do, and it's better to pay the dividends rather than have enormous piles of cash accumulating and losing its value due to inflation. And lastly, growth, we already looked at it, but in here we have a nice table that shows 10-year, 5-year and 1-year growth. So we can see that the revenues, they are growing rapidly over the period of last 5 years. There was a slowdown in recent years, but still the growth is significant. The 10-year average is 30%, 5-year average is 26%, and 1-year average is 9%. So this is a quickly growing company. And earnings per share, they are correlated to the growth in revenues. At least they were. Only in last few years, 2-3 years, the earnings slowed down compared to revenues. And the price grew around 10% per year in 10-year period. In 5-year period was 2%, but most importantly, in 1-year period, we can see that it dropped 22%. So the drop in price, it started much earlier on this company, but as we can see here on the price to earnings ratio, the company has been going down in its valuation since 2020. So the last 2-3 years, it was all in here in terms of P ratio. Last 2 years, the company was going down in price, while the earnings stayed similar. So this is a great opportunity to take in terms of the price change compared to the fundamentals of the business. And lastly, we look at the competences of the management. So TXT is led by a disciplined founder-driven management team with a strong focus on product quality, profitability, and capital efficiency. They have consistently maintained high margins, avoided debt, and returned most of their profits to shareholders through dividends. So the avoidance of debt, if you have such a great margins, I would say it's not a good thing, but in their case, they have too much money. They don't need debt. They don't need extra financing, as they are just drowning in money. They are not able to invest all of it, and they are giving it out to shareholders, providing a lot of value through dividends. The leadership demonstrated clear alignment with investors, and they are holding a significant stake in the company. So the leaders also have a good amount of shares in the company. All right, let's make a summary. Circle of competence. I would give this company in here 7 out of 10, because it is not the easiest company to understand, but still it is quite solid. The consistent of revenues and earnings, I would say it's a 8 out of 10. They are consistent, although the recent years the earnings kind of slowed down, but this gave the opportunity for the other investors to be scared and to drive down the price. The margins are excellent. I will give it 10 out of 10. They are going down a little bit in recent years, but still margins like that, it's just been a long time since I've seen something that can be even compared to this company. Maybe Google can be compared to it, but Google also has 10 out of 10 margins. The debt levels, I would like to see some leverage here. I would like this company to be able to invest more and take on more debt, but sadly they cannot do that, but it's fine. I will give it 9 out of 10, as this company is very, very safe, even too safe, at least for me. The durable competitive advantages. So this one is very difficult to say how durable are those competitive advantages, but one thing I want to note here is that they are going to use AI, so there is a shift coming into their business and they are well equipped to make good use of this new technology. But I will write a null here, as I'm not really sure how durable are their competitive advantages. The retained earnings, they were growing significantly, but they dropped in recent years. So I think I will go with 6 out of 10. Maybe this is too harsh, but for me it's better to be cautious than greedy, especially that I am after a period of nice gains on the stock market, so I'm probably a little bit more optimistic, so have that in mind. The valuation, based on the historical prices, the current valuation is amazing, but there is some problems with the growth of the earnings, so I will go with 9 out of 10. The cash flows, goddamn, the cash flows, they are good, but there is a ton of dividend payments. And if you love dividend, the cash flows are amazing. But for me, I would give it maybe 7 or 8 out of 10. I just don't think that the dividends are the most efficient thing that the company can do with its money. And the growth was amazing, but it slowed down in recent years. And how honest and competent is the management? I will also give it a 7 out of 10, as they own a lot of shares, they're paying dividends, so they care about the shareholders. Okay. Let me make a little break here and I will sum it up and take an average of those numbers. All right, so I've calculated it and the average is 7.8 out of 10. So I think it is solid, especially the margins. They are crazy. 10 out of 10. It should be like 11 out of 10. Maybe 12 out of 10. Margins like that, they happen very, very rarely. But on the other hand, I can be a little bit too optimistic. However, you know, the way I feel, it changes every day, so it's really difficult to say. But yeah, this company looks very promising. Okay, thank you for the attention. I hope you learned something and that now you know one more great company. And lastly, before I end, I would like to do a short advertisement. If you need help, for instance, if you are losing money on the stock market, or if you are unsure about certain investment you did, or you just want to know more about a company, feel free to contact me. Here's my email. I can do financial analysis of the company, so something similar to what I did here. I can look at the reports, I can analyze the business environment, etc. So yeah, if you need help, feel free to contact me. And remember, if you have a big capital, spending some extra money on a good quality analysis that follows the approach of the best super investors worldwide is a sort of investment. It's not a real cost. So yeah, thank you for listening and I hope you had fun. I wish you a great day. Thank you for listening.